Hello.
In this video, we're going to just quickly look at a couple of stocks that are interesting at this point, LLY and Google. In other videos, we've actually looked at these in the past, and they've had great runs. And I was running a scan for stocks that have performed better than the S&P, specifically really big companies, so bigger than 200 billion. So that's considered mega cap stocks, and just some of these, well-known household names that are performing really well. And a couple that came up on the list were Eli Lilly and Google. And so, despite having performed well already, there's still some interesting things going on here. So, just briefly, let's look at Eli Lilly, and 29%. It's up year to date versus the S&P 500 Spider ETF, which is up 7.3%. Eli Lilly up 95% over the last year versus 24% for the S&P 500. Earnings per share expected to grow on an average of 51% per year over the next 5 years. That's really big growth. And so huge profit increases expected over the next several years. For reference, the S&P 500 average growth rate for stocks is around 9, sometimes up to 10%, but in that kind of upper 8 to 9.5% usually. So this is really big growth compared to what we'd find in a typical stock or an average stock. They've increased revenue every year since 2018, just a nice steady uptrend. Earnings per share has increased an average of 17.5% yearly over the last 5 years. So they've demonstrated great growth performance over the last 5 years, and it's even supposed to be better over the next 5 years. The one thing some traders may be concerned about is it has a really high price to earnings ratio of 129 right now. But since these earnings are growing or expected to grow so rapidly, that PE drops off very quickly when you look out to earnings a year or two down the road. Price range is at the bottom of a range. So we've had this really nice run up since early 2023. Big run up, kind of moves sideways, and a big run up, kind of moves sideways, big run up. And now we're in one of these sideways periods again. If we draw a little rectangle around this, you can see we just kind of bumped a little bit below that prior low. We had that low there, that low there. This is our third low, and we've started moving up off of it. So maybe not a bad entry point if you like the stock overall and it's starting to move up. There's some potential for it to move up within this range, and then ultimately, I guess the long-term goal would be the breakout, depending on how long you wanted to hold it. So short-term traders, long-term traders, there's some opportunities here as it moves up, and potentially the breakout. And stop losses could go somewhere below the bottom of this range. So that one's interesting technically, and fundamentally obviously doing pretty good. Google, let's bump that up so you can see it a bit better. Alphabet, parent company of Google, up 15% year to date versus SPY, which is up about half of that. Google up 51% over the last year versus 24% for SPY. So again, about double what the S&P 500 is doing. Earnings per share expected to grow an average of 18% per year. So again, that's double what we typically see for S&P 500 stocks. So very strong growth compared to most other stocks in the S&P 500. Increase revenue every year since 2014, and they've been doing a great job of raising their profits each year over the last 5 years as well, close to 24% per year. It's in a choppy uptrend and near the top of a channel. So we can see, going back to start of 2023, it's had this pretty kind of whipsaw, moves up a little bit, drops. I like using a zigzag indicator. It kind of shows the percentage movement. So we've had some 27% up, 18% down, 45% up, 10% down, 22% up, 14% down, 28% up, 15% down. And we moved up 22%, had a little bit of a pullback here. So this could continue to run higher. We have had these bigger runs like this one where it popped up, moved sideways for a bit, and then had another run. So that could happen, or even here, there was this little pop and then it paused out. So we're up 22% off that low without a 10% pullback. You can kind of see from these pullback numbers that when the price pulls back 10 to 15% over the last year and a half, that's a pretty good buy point. So there is that option to wait for, a 10%, 15% pullback off the high. But there's, of course, the option that, or the possibility that the price continues to run, especially if, let's pull up the S&P 500 here. It pulled back, and if it starts to run, these stocks may as well, but that's unconfirmed at this point. We're in a pullback. It's starting to recover, but we don't know if we're just going to surge back to new highs or not. So some options in Google on how to play that one. If you like the long right now and it keeps going up, there's always that option to enter. Stop loss can be kept fairly small in the case it does pull back, and then if it does start pulling back, look for that deeper entry that we've typically seen on these pullbacks. But overall, two mega cap companies that are looking pretty good, even as the S&P 500 declined a little bit over the last few weeks.